I am a senior analyst, a senior sustainability consultant at Kirchhoff, and I also lead the ESG risk management cluster. So I'm not alone today. I'm joined by a guest from MSCI, Nadia Lane. Nadia is an executive director at MSCI, and she is also head of ESG ratings and sustainability model product. So a little bit more about myself. I used to be an ESG rating analyst at Morningstar Sustainalytics, where I was also on the other side, assessing companies on their sustainability performance. And then I switched to the consulting part where I can directly work with companies to improve their performance on the one hand, and also make sure that these performance translates into their ESG ratings. So between Nadia and I, we have experience both from the rating agency part and also working with companies on the corporate side. So that is a little bit of background for the two speakers today. Um, you are free to use the chat function. So the camera is disabled, but you can use the chat function. And as we go through the slides, as we go through the webinar, if you have any questions, we encourage you to drop them in the chat. When we open the floor for the Q&A, you will be able to, we will be able to respond to your questions. So just to let you know that at any time it pops up, you can drop your questions. And when we get to that, we'll address your questions. And I'm sure a lot of you have questions on your MSCI ESG ratings, and also for those of you who do not have ratings, maybe no MSCI ratings, or you're rated by other agencies. So whatever the questions that has to do with rating related, we are going to address them within the time limit that we have. So that leads us to the agenda, an outline of how we're going to go through the session today. So we have four main things on the agenda. First is an introduction. So this introduction, I'm going to lay the framework for the discussion today. And chief among that is we'll look at the opportunities that are available in the sustainable finance market today. And then we will look at the challenges for companies and the complexity of the rating landscape. And then what opportunities that present and the benefits for companies who are able to navigate this maze of complex and maybe sometimes also and divergent demands. And then we will switch to the MSCI rating methodology and other insights from MSCI. That is the part that Nadia is going to be taking. So after running through the introduction in the first couple of minutes, I'm going to hand it over to Nadia, who is going to give the insider perspective as head of ratings. She's involved in methodology development and also getting feedback from companies and implementing them, integrating them into these processes. So she's going to bring the insider view. And from there, we're going to move on to the Kirchhoff side, where we show the common pitfalls and the challenges that companies have in their ratings, and how the method and the process we use to help companies going from defining their strategy to continuous improvement. And then we will leave the floor for the Q&A session. So this we will do in the next 55 minutes. So getting started, this is a quote from BaFin, that's the German supervisory authority for the financial sector. So it shows that interest in sustainable financing, the interest of investors in sustainable financing is increasing. So more funds are being marketed as sustainable funds, and that means there's more capital inflow that are being directed into ESG-oriented investment. So that is the opportunity I mentioned earlier on, where we see this in the capital markets for bonds and other sort of financing for companies. We see that more funds are being released and flowing into this aspect for sustainability and sustainable aspects of companies. And what this means is it creates opportunities, but to unlock these opportunities, we see that there is also a demand to have these ratings, which will prove to the investors and help to unlock these funds that are available in the market. But here we see a very complex landscape. You see some familiar names of rating agencies. We have MSCI, we have Sustainalytics, ISS. So for some of you here, you only have to deal with one or two. For others, you have to deal with quite a number of them. So, and as mentioned earlier, the requirements, the methodology, and other sort of improving your sustainability performance can be different for these different rating agencies. And so in addition to not just ESG rating, you also have credit ratings, and then trying to meet these competing demands. So that creates challenges for companies. So on the one hand, you have these opportunities based on sustainability linked financing with better terms. And on the other hand, you have the challenges of navigating through these complexity of rating and divergent and demands from the rating landscape. So how do you go from here to the position where you can key into and tap into some of these benefits by having very good or best-in-class rating? So here in this study, which is also an MSCI research, we can see that over the 10-year period, over almost a decade, you see that there is a differential. So here talking about interest rate differential between those who are at the top of the rating table and those who are at the bottom. So here, what it means is that even just a 52 basis point interest rate differential. So for a lot of companies represented here today are large companies. So even this seemingly little differential in terms in interest rate can translate into millions of euros that a company at the bottom will have to pay, or that a company at the top will not have to pay, all because they were able to handle the complexity and the challenges and the requirements of the different agencies, and then translate them into best-in-class results. And also another study by KPMG. So we see a couple of numbers here. So talking about 75% of companies that are linking their financial performance directly to sustainability. And this is something that is very important for companies to say there's a direct nexus, a link between what they are doing in terms of sustainability and also their bottom line, their financial performance. I talked about having to pay less interest, for example, or the cost of debt, the cost of financing. And when these go down, you see that it reflects in the bottom line and the financial performance of the companies. And then we also see that 59% are continuing to allocate more resources to invest more on sustainability measures over the next couple of years. But most importantly, is this number 54%. So what does this mean? A lot of companies do not yet, so more than half of the companies surveyed, they do not yet regularly quantify the financial impact of their sustainability measures. And why is that important? This is what the rating agencies tend to do. So a company has these measures, and they have these policies, and they have their business model and strategy, and they implement different initiatives. But in the end, what does it translate into? So the rating agencies, they look at this, they assess this, and they're able to give a score, a number, or an assessment of these performance. And then this is what will give the investors, asset managers, a quantitative number to work with to say you are up here or you are down here, and that ultimately affects the decisions of these stakeholders. So this is sort of like setting the framework of what we are going to be looking at today, the challenges, the opportunities, and how companies can translate sustainability performance into growth, into financial performance, and into recognition. So at this point, I am going to hand over to Nadia, who is going to take a look, deeper dive into the MSCI ratings, the methodology, and other upcoming information and insights you should know. Over to you, Nadia.
Thank you, Alexander. Good morning, everyone, and thank you for inviting me to this webinar. So as Alexander just said, I will spend a few minutes going into more details around our ratings. What do they try and measure? What are the key building blocks of our methodology? How we interact with issuers, and so on. And then also talk a little bit about how we work with companies, both rated companies in terms of peer benchmarking support, but also unrated companies and what's available to you if you're not currently part of our rating universe, or you're a private company, for example. All right, so let's jump straight in. So if we can move to the next slide. Okay, so a few things I wanted to highlight here. Maybe I'll start by emphasizing that our ratings are designed to support an investment use case. So we're trying to help investment managers identify potential risks or opportunities in their portfolios that might not be visible via traditional financial analysis tools. Data on sustainability themes can be very useful and material to managing portfolios. So the model aims to measure a company's exposure to industry material sustainability risks and opportunities, and then assess how well the company is mitigating those risks or capturing the opportunities versus its industry peers. The signal, so the final output, the AAA to CCC letter rating, is industry relative, and this is really to help investment managers who are managing broadly diversified portfolios to identify outliers or leaders and laggards within each sector. The ratings are very data and model driven. So of course, we're increasingly leveraging AI techniques to extract relevant data and increase the speed at which we collect data as part of our QA processes to analyze any or spot any anomalies, any outlier values, and so on. But of course, ultimately, the process is overseen by analysts who have both industry and market expertise. So these are really the core points I wanted to highlight on this particular slide. But let's jump to the next one. And what you can see here is our key issue framework. So we typically select between 4 and 8 key issues per industry, bearing in mind that governance is universal. So the issues you see, and apologies, the colors, it makes it difficult to read, but on the right-hand side under the governance pillar, we look at both corporate governance and corporate behavior, and we assess all companies, regardless of industry, on all of these issues. But for the environmental and social pillar, we will focus on the themes here, the key issues, so the pale grey boxes that are most relevant and financially material for the particular sub-industry we're looking at. So I think it's fairly intuitive that, you know, for example, for a mining company or an oil and gas company, we would be looking at things like carbon emissions, toxic emissions and waste, you know, water stress for mining companies, for example. We might also look at health and safety. For a bank, we would likely look at issues like human capital management, consumer financial protection. We might also look at privacy and data security. So the types of key issues we focus on will depend on which sub-industry the company is in. So how do we go about selecting and weighting those issues? So on the next slide, here we present a sort of much more simplified way of the annual exercise we go through. So this is something that we review and we recalibrate annually. And so the way that we select the key issues that are most material to each industry, again, is very data-driven and quantitative. So we collect and review quantitative indicators that help us identify which sub-industries are most impacted by or have the biggest externality on a particular issue. So going back to health and safety, we collect injury rates and fatalities, and we review that on an annual basis and identify which industries are most impacted. For the water stress key issue, we look, of course, at water intensity. For product safety and quality, we will look at, you know, product recalls, for example. We also collect data on the number and frequency of data breaches, which we will look at when we're assessing industries on privacy and data security. And it's important to continue monitoring that regularly, and that's why we recalibrate the model annually. And as some of you may know, we also consult with clients and corporate issuers on any model updates and enhancements we're looking to make. And that's really to ensure that our model continues reflecting the latest trends in sustainability and climate themes, as this is a very dynamic space, and we see the data evolving quite rapidly. Okay, so on the next slide, this is really to the previous steps at the industry level. Now we move to the company level. So this is where we assess the company's specific risk exposure and how the company is managing each key issue. And to assess the company's specific level of risk exposure on a particular key issue, we will be collecting information on a company's business segments, revenues, types of operations, the location of operations, and this will help us build a more company-specific level of risk assessment on that particular issue. So that could be water stress, for example, and again, going back to my example on a mining company, it's important that we look at what types of mines are being operated, where they're being operated. Is it in regions with high levels of water stress? And we get very granular there, looking at water basin levels, not just the country or the region. And we look at the company's locations and so on. So that's how we assess the risk exposure. And typically that data comes from, you know, your mandatory financial disclosures. So this is data that is more widely available. So this will then allow us to assign a risk exposure score on that particular key issue. And then we look at a company's management capacity. So we will typically there scan sustainability disclosures and look for policies and commitments, how granular and extensive these are. We will look at programs and initiatives, so targets, for example, to reduce water intensity. We will look at various performance indicators, and we will also look at whether there are any controversies, so performance issues, that may have been reported by the media, and we will assess those, and where relevant, this will lead to a scoring deduction. So this is typically the piece of the model where companies can more directly influence their assessment by having best in class and leading policies, commitments, targets, and so on, and demonstrate a strong track record on mitigating those risks. Okay, so this is just briefly, we then aggregate the scores and they roll up to a weighted average key issue score, which is expressed on a 0 to 10 scale. And then we adjust that score and make it an industry relative score, and then we convert it into a letter rating. So the top two levels of the model are industry relative, so the letter rating, the final industry adjusted score. Below that, it's more of an absolute score. Okay. So then I wanted to spend a couple of minutes just drilling down into the sources that we use, as I know that that's a common question. So what this shows you here is that, of course, we look at company disclosures, and they are an important input into our models. So we look at both mandatory, typically financial disclosures, as I was describing earlier, to collect information on business segments, revenues, location of operations, and so on. And of course, we look at voluntary company sustainability disclosures. And those in aggregate typically contribute around 2/3 of the inputs into the model, but the rest, and it's not an insignificant portion, is what we call alternative third-party independent sources. So we also look at data from regulators, data from specialist academic sources. I mentioned water stress earlier. We look at the World Resources Institute, for example, and leverage their global aqueduct database on water basin water stress levels. We collect a lot of regulatory data, once again, on product recalls, data breaches, consumer complaints, and so on. And we also, of course, monitor news and media to identify any potential controversies. So for us, it's very important that we build that full 360-degree view of the company, looking at both what the company discloses, but also what third-party independent specialist sources can also bring to enhance the assessment of the risk exposure. As well as collecting information from public sources and of course your own disclosures, we engage with issuers. As many of you will be aware, we have an online issuer portal, which is on our MSCI One platform, which all rated issuers have access to. On that portal, you can review the data that we collect on your company. You can submit feedback, submit questions. You also have access to our issuer communications team to, again, submit questions where relevant. One point to note is that we, of course, review the questions, the feedback. We will only incorporate it where it's material and relevant to the methodology and what we're assessing. Of course, our methodologies are available publicly, are very detailed. We try and provide as much documentation as possible. We also only take into account feedback, for example, on if you have a new enhanced policy, we would need the link to the public document where that policy is available. So we only incorporate in our assessments publicly available information, but no private information. So this is very important as part of our model. Okay, so that's on the model, really. Just a couple of words here on this slide. I think Alexander already touched on this and highlighted how a rating can a higher rating can also lower financing costs and cost of capital. There are a number of studies out there. We have many of them available on our public website that show, the financial relevance of MSCI ESG ratings, various links that we have explored in both our own research, but also in independent academic research, looking at, companies with higher ratings and what the impact can be on things like systemic risks, valuations, and so on. So I would encourage you, if you're interested, there are links here to many useful studies that are available in the public domain. Okay, so I think then we wanted to pivot and spend a couple of minutes on how MSCI works with companies. Let me move on to the next slide. Okay, so we see a range of areas of interest from companies and needs that lead to companies contacting us, and there are various ways that we can support that. So, of course, again, if you are a rated issuer, you will have access to a number of resources on our website and the issuer portal free of charge, in terms of methodology documents, ability to review data, access to your own rating, your scores, access to a number of drill down dashboards that help you understand the rating, and also a change attribution tool to help you understand where we have published an upgrade or downgrade, what the key drivers were. We also have a number of benchmarking tools which companies can license to help them understand how they're positioned versus their peers on their rating, but also on a number of other sustainability methodologies and climate methodologies that we offer. We have a number of services that can help you promote your sustainability or ESG profile as part of a debt issuance, for example, or linking a KPI to a sustainability linked loan or credit facility. So you can license your MSCI ESG ratings badge for that, for instance, and we also offer second party opinions. Now, for non-rated companies, for example, if you are a private company, or if you are a smaller company that's not a member of the indexes that we track. So we define our coverage universe for ESG ratings in terms of inclusion in certain indexes that form the basis of the definition. We can also offer what we call provisional ratings. But before I move on to, sorry, Alexander, if I just move back one step. So in terms of for rated issuers, there are three levels of sort of benchmarking support that we can provide to help you understand your rating, how you're positioned versus your peers, understand the methodology and the data inputs and so on. So you can subscribe to the ESG Ratings Report Plus solution that gives you access to the full detailed, in many cases, very long ratings reports with many benchmarking insights, as well as your industry reports. You can then also subscribe to our Corporate Sustainability Insights solution that gives you access to the data on all your peers across ratings, controversies, and so on. And then CSI Plus, you see on the right-hand side here, also allows you to engage with our experts to do deep dive sessions on the methodology and your particular assessment. Okay, and then just to finish, hopefully we're on track with time, Alexander. But for the last point I wanted to highlight, as I know many of you on the call today are not currently rated by MSCI, we offer provisional ESG ratings. So these are really designed primarily for privately held companies or public companies that are not part of the indexes that we use to define our coverage universe, maybe because you're smaller or you don't meet the criteria around free float or liquidity and so on. So this really allows you to obtain an assessment that gives you you know, a baseline and helps you understand how you might be assessed on the MSCI ESG rating methodology should you come into our coverage universe. If you're a private company, for example, if you're preparing an IPO, and you might at some point enter one of the MSCI indexes, then this is a useful tool to help you understand how you're positioned versus your peers, obtain a preliminary rating, a provisional ESG rating, and it's important that that's denoted. So it's explicitly labeled differently, and typically is used for internal purposes, but can also be licensed for external marketing purposes, for example, for pre-IPO roadshows and so on. So it's a service where we take you through the full methodology and assessment, walk you through what data we typically use to make the assessment. In the case of a provisional rating, we can include private information because it is a provisional ESG rating. And then we walk you through, once we've compiled the final assessment, we walk you through your full report, your full rating, and so on. So that's the provisional ESG rating solution. So I'll pause there and hand over to Alexander for the next section, and yeah, happy to take questions at the end.
Thank you very much, Nadia, for the insight into MSCI rating methodology and how they work with companies. I hope our audience, in case you have questions, please feel free to drop them in the chat, and at the end, we're going to take your questions. So we will be moving on to we're going to take a short little moment to take a poll. So you're going to have this question. I hope you start seeing the questions, then in your chat, and then give a response to it. So we're going to do a quick poll, and the question we're asking all of you from different companies across different industries and sizes, having to do these ratings and also supporting your company's sustainability efforts. So the question is whether your ESG rating, so for some of you it might be one, for some of you it might be a couple of ESG ratings. Do you think that the results you get from these ratings, if they are an accurate reflection of your company's sustainability performance? So that's the question, which is going to come up in the poll, and then you have a couple of options, 3 options. You choose one, and we will see what the results are. So we have the results coming in. Just going to give a couple more seconds for others to also take the poll. But the numbers as they trickle in, just to give a summary of what the results are saying. So about half of the attendees who have participated in the poll, they think they have ratings, but they don't think it accurately reflects their sustainability performance. So just about 40% think it accurately reflects their sustainability performance, and 11% say they do not have an ESG rating. So just a couple more seconds, and then we will proceed. So just to recap the results, half of the attendees have ratings, but they do not believe it's an accurate reflection of their sustainability performance. While a little under 40% thinks it reflects their sustainability performance, and the number for those who do not yet have an ESG rating stays around 11%. So we're going to move on. So what this means, what the results of this poll and the significance of this poll, what it means for companies. Like we stated at the beginning, you see a lot of companies who um, uh, invest a lot of time and resources creating these initiatives, creating these policies that have been discussed by Nadia, which the rating agencies they require from companies, and so putting all these efforts, which do not, in their perception, translate as interpreted by the rating agencies into a result that reflects that performance, and that can be a sort of frustration for a lot of companies and they believe they are doing what they need to do to get um, a good rating, and also the pressure that is coming from. So for those of you who are maybe leading the sustainability department, corporate sustainability leaders, or ESG managers in your organization, and then you see the pressure that is coming maybe from board and senior management, and the investment the company is making, and how this is doesn't reflect fully in the ratings. So that is the challenge, at least that's identified by half of you. So we're going to move on to into more details about these challenges and how companies can navigate them. So here we look at why is your company underrated? So surprisingly, for a lot of companies, we have a visibility issue. So what this means is that although your company may have been implementing some sustainability measures, but these are not directly visible. And in the MSCI methodology, for example, and not just MSCI, this is also something that has been done across other rating agencies as well. So even for some of them that used to accept internal documents, they no longer do that. So that means everything you do has to be out there in the public domain, in the public space, for it to be visible. And another part of the aspect of this visibility question is if you are actually reporting everything you do. So some things that you think may not count may actually count. And if you're not putting it out there, if it's not in your report, if it's not in the public space, then it's not being taken into account in the assessment. And then another factor are the KPIs that appear comparable. So for those of you that have been engaging with rating agencies, receiving these rating reports, and also helping your companies to go through this rating process, you see that in the results, you see a summary of where your company stands relative to another company in the same industry or sub-industry or sector. So what this means is that not just the assessment, not just the performance of your company is being evaluated, but also in comparison to the others. So where do you stand? So this means you also have to look beyond what your company is doing and look at what the leaders are doing, what the best in class are doing. And for some, they go far more in the level of detail, the number of KPIs they provide. And this translates into a better result for them. So if there is reluctance within your company to disclose certain key metrics, you should understand that that also translates into not getting the full points you get, which also translates into the rating outcome. And the third point I'm going to mention here, it's the third point, but it's arguably the most important of these three aspects we're looking at. Because if your company doesn't have a strategy, we see the complexity of the landscape of the competing demands and divergent methodologies of different ratings. If there is no coherent strategy that takes a broad look in the beginning and make the right decisions on what are we going to focus on, What benefits are we going to get from this? And how do we go about it? How do we go about an MSCI rating? How do we go about an ISS or S&P Global rate? What are their requirements? What disclosures do we need? So this strategy at the beginning, where you plan in advance what you want to disclose, how you want to do it, what your goals are. And this strategy also takes into account, because for some company, the ratings are not just for themselves, they are actual requirements from their business partners. So they need to show that they have a certain threshold of rating. So what do these business partners require? What is the threshold you have to meet, the minimum performance, and how do you get there? So this is something that has to be defined. But what we've also seen is that a lot of companies, they are sort of like reactive, to take a reactive approach. So maybe they get a mail from a rating agency and then they can either decide to engage or not. But it's very important for companies to have these going forward. And here we're going to look at we're going to examine three major pitfalls that companies have, which is sort of like inhibiting this transition from being a low performer to a high performer, or in the balance of MSCI ratings, they call companies at the bottom of the rating class, laggards, and leaders are those are the best in class. So with a double A or the triple A. So the challenge for a lot of companies is how to make this transition going from laggard to leaders. This is very challenging, has to do with a lot of documentation and disclosure to make this leap. But in attempting to do that, we've identified some common pitfalls that companies make, which is sort of like making the transition and the leap difficult. So one of the pitfalls we recognize, I touched a bit on it, is visibility issues. So and also the results of the polls, what it shows that performance does not automatically mean recognition. So what this means for companies is that they have these efforts and investments in sustainability, but the results, on the other hand, do not fully reflect these performance. So what could be the reason? So I talked about policies and measures. So there are certain expectations for policies. And believe me, these expectations are not always harmonized across rating agencies. So for those of you that your companies have to deal with multiple rating agencies, you should understand that the requirements and the extent of granularity, the topics that are material, the key issues for your company. So how are these reflected in your policies? And also the measures. So some measures will speak more to the methodology, the assessment and criteria of some rating agencies or not. So not having these as required by the rating agencies means also not having the score. So in the end, the reporting part means how do you disclose this? So on the one hand, it is not about going to make bogus claims. That's where we're number one in this, or we do that, which is sort of like the greenwashing, but also not shying away from disclosing what you actually do just because you think that might be seen as being blowing your own trumpet. So that is the opposite concept to greenwashing, which is greenwashing. So finding the balance between not making bogus claims, but actually disclosing what your company does. So this is the first pitfall. And the second is the materiality blind spots. So there are requirements. Companies have these double materiality assessments according to the EU regulation for sustainability reporting. So what we see is that companies, they have materiality assessment, and then they say this topic is not material for us. So that means they do not create policies and actions and targets for those topics. But in the assessment of the rating agencies, a topic, just because of the industry and the business model of the company, will be relevant. So what that means is that the company, on the one hand, the company has not taken that topic as material for the company. But on the other hand, the rating agencies, they assess these as a key material issue for the company. So they expect certain policies, certain measures from the companies, which are not available because the process internal. So what it means is that you look at your industry and then you look at what is required for that industry. And when you go through your materiality process, you also, the outcome of that materiality process does not confine you to making disclosures and having these measures only on those topics, but you also look at what are the other topics that are key for in the industry we operate in, which these rating agencies take into account. And then we have the governance black box. So for a lot of you here who are sustainability managers, ESG managers, and leading the corporate sustainability and responsibility effort in your company, you sometimes face this difficulty if there is no buy-in at the senior level, at the board level, and then some of these initiatives that you need to implement to improve your performance, which will be taken into account by the rating agency. So you don't get the necessary support, you don't get the necessary buy-in, and that means that you continue to find it very difficult to make this transition from laggard to leader. And also at the board level, at so another governance topic is this incentive. So if there are no incentives if the compensation is not tied to some of these short and long-term incentives at the highest level, it makes it also difficult for these to translate into more resources, more investment, more support for the sustainability initiatives that are needed by the organization to make this transition. But for companies who are able to navigate these pitfalls which we've identified, we can see how so this is actually a case of a company which we've supported over the last couple of years to go through this process. So what this means is that although difficult and challenging, but it is a possibility. And this is a case of a company who has gone from B, which is the worst in the MSCI rating assessment, to double A, which is the leader, the best in class. And you can see, based on what we have discussed so far, what this can mean for the company in its business relationships, in its financing terms, and other aspects, the attractiveness to investors and business partners, and even to clients and customers, because these are not just numbers and letters, but it means that a lot of investment, a lot of new initiatives and actions are going on in the company to enable these transitions. So it's not about just getting the result at the end, but how these are translated into making the company a more sustainable one that has a better impact on society, on people, on the environment. So I'm going to go through the process we use to guide companies from starting with a rating strategy to continuous engagement. And so this is actually a six-step process with 6 phases where we support companies to make the leap. So as I mentioned, we start with a rating strategy because that is the starting point. So this strategy helps to define and to refine what the companies need to focus on, and how resources can be prioritized, and what their goals are, and to meet these competing demands, and what kind of strategic approach do we want to use for these multiple ratings in the complex landscape. So when we set these clear goals, these clear priorities, and refine them, so we then move on to the mapping stage where we're able to see what the company has, what resources are available, what metrics, what tools are available, and then we can now go to the strategic gap analysis. So in the strategic gap analysis, we look at the status quo of the company, what it has, where it is, and we compare that to where it wants to be and what is required to get there. So there we see this gap between where they stand and where they want to be, and then it gives a clear picture of what needs to be done. So then we move to value creation. So in value creation, you're going from how do we now create these processes, these systems, these management systems that are needed? How do we develop the documentation, collect the KPIs? So all these that's actions that need to be in place that have been identified in the previous strategic gap analysis, we then implement them here. And then so you can see here that it's actually a process of value creation and not just ticking the box or greenwashing. So, and then we move to a communication strategy. We talked about visibility earlier on. What your company is doing, is it reflected in the results? So this has to do a lot with the communication, how you're making your disclosures, what you're disclosing, and then in the end, when we go through all this process, we see an improvement in the rating and the assessments, and then we continue to take feedback from there and continually engage to ensure that it is one thing to also get to the leader position. It's another thing to stay there to defend that position. So this is part of what we also do. So this a summary of the six phases we have for strategic rating improvement, but it gets more granular than this, but just to give you an overview. So what does this mean for your company? Why do you need to go through all this? The reason is simple. There is a strategic payoff when you do this. So all these investments we talked about, creating these actions and collecting these KPIs, the data center management, buying the resources that are invested, what does it translate into? It drives value. So we can see that your company can go from having this performance that was not recognized by the rating agencies, not reflected in good ratings, to having that recognition. So the rating agencies, they begin to understand that your company is actually being aggressive, to use that word, in terms of what targets they would want to meet, the investment is making, and how serious the topic is for the company. And these, when you get this recognition, so you're having the best-in-class ratings, this of course attracts investments, it attracts better terms, it attracts business partners who want to do business with you, because that is also part of their supply chain due diligence. So depending on what part of the chain you are, people want to know, clients, customers, they want to know also that in sourcing your materials, you are responsible, you are contributing positively to making the world a better place. So this translates to growth for the company. It affects the financial performance. It affects the bottom line. It leads to attracting the best people, client retention, and also retaining the best talents. So that is what it means, what's in for your company when you go through, implement these processes, and is reflected in your results. So just to wrap up, what does it take to go from this challenging landscape of competing ratings with many demands to being in the position of recognition and growth, industry specific? So I talked about the key material issues for companies. So having these, what is needed for your industry by the rating agencies, and making sure that you're consistent and structured in providing this evidence. So thank you very much. This wraps up the presentation. We're a little bit over the time, but we're going to quickly take questions that you may have. So the floor is open, and there are a number of questions. If we'll try to take what we can as quickly as possible, but be rest assured that if your question is not taken during this session due to lack of time, we're going to respond to your questions later on. So
maybe I can, Alexander, I can jump in as I've been reading through the chat and the various questions. So that there's quite a few. I think there was one on CSRD reporting requirements and, you know, the challenge perhaps for smaller companies that don't have as many disclosures. So I would just say that CSRD reporting is not a requirement as part of our ratings framework and the data we look at. We do look at some ESRS aligned indicators, but it's not a prerequisite. We are more focused on data and indicators that can help us assess how well a company is mitigating the risks that are most relevant, again, through that financial materiality lens. So I would encourage you to focus really on that. And we are, as much as possible, focused on really quantitative performance indicators that really help us differentiate performance. So the rating itself, the assessment, is not assessing the level of transparency of a company or how extensive its reporting is. It's really assessing how well it's mitigating most relevant risks, just to highlight again. There was a question about the update frequency. So typically, so we collect data throughout the year, depending on the type of data. So for example, carbon emissions data will be collected more frequently, and where relevant will flow into the data we use for ratings and impact the scores. But typically, we do a full review of a rating on an annual basis for companies. But again, some of the underlying components are more dynamic and may change at different points during the year, but the full rating review typically at the moment is refreshed at minimum once a year. I don't know, Alexander, if there were any others you wanted to take.
So there is a question about, we have just a minute. What I would say is, what is the one key message takeaway you have for our attendees, for those who have a rating and then finding it difficult to make the transition, and for those who do not yet have an MSCI rating?
I think maybe two things I wanted to highlight in the 1 minute, and I think it was one question. We are preparing a methodology update, which all of you who have an MSCI rating will have received multiple communications on. We are holding the next webinar on this methodology update on the 4th of February, which you can register for. There's lots of resources available on our portal to help you understand what these methodology updates entail. The model itself is not changing fundamentally, but we are making some tweaks to some of the indicators and so on. So that's coming up, and we are planning to release that in March. So again, please reach out to us if you haven't seen any of the information on this. We have sent out multiple communications. In terms of improving your assessment, of course, it will depend on the company and the industry and so on. But generally, we're looking for companies to disclose, detailed and granular disclosures on the policies and practices they have in place. So, for example, if you have a high exposure to human capital development, stronger management practices, which can be, for example, regular employee engagement surveys or formal grievance redressal mechanisms, are commonly the types of indicators and practices we see amongst higher scoring peers. I would also highlight, and I think that was another question, that governance is a very important pillar within the model. The reason for that is that it's really the foundation of good risk management, and typically investors start with an assessment of corporate governance. It's really the starting point, the foundational layer, and often carries a high rate in our rating, again, depending on the industry. So those two areas are important.
So we're a minute over slotted time, and I understand attendees, they also have other commitments and meetings. So I want to thank you very much, Nadia, for being a part of this webinar and giving our attendees direct insights on the MSCI ratings and also responding to questions they have. And also a big thank you to all of you who attended, who took the time out of your busy schedule to attend the webinar. Please feel free to reach us with any questions you may have and other topics you may want to discuss. And then we're happy to respond. We're happy to be in touch with you. So thank you very much, and I wish you all a wonderful day ahead. Thank you.
Thank you all.